If you couldn't tell by the state of my voice, I've been having many great conversations on policy with you all, and we're about to have another one on tax. I think the IRS broker rulemaking, which is the focus of our conversation here today, is definitely a worthwhile one for us at the summit. In my opinion, and the IRS broker rulemaking is one of, if not the most real and active threats that the industry is facing right now. And thank you, Vera, Lawrence, and Michael for joining us today. Michael, let's just get into it because we don't have a lot of time. Let's go with the origin story of where the broker rulemaking came from.
Thanks. So how did this whole thing start, and how do we end up in this mess? All started back in 2021, and the genesis of all great tax policy. They were looking for a pay-for. Looking for money off the shelf to fund the then Infrastructure and Investments Infrastructure and Jobs Act. And so this was scored at roughly a $28 billion provision back then in 21 at the height of the bull run, and that this was somehow going to raise this revenue by implementing a broker reporting rule for cryptocurrency to capture what was perceived to be a large tax gap. And in spite of multiple efforts to narrow the definition of what is a broker under the rule, those efforts all ultimately failed, and we ended up with a very broad definition of broker that was adopted into section 6045 of the code, and it basically ropes in a large part of the industry into what was originally built as just a TradFi reporting rule. You're probably used to seeing these. You get a 1099B for investments in stocks and securities and other traditional financial instruments. Well, this rule was intended to just extend basically those traditional rules over to cryptocurrency, to get cryptocurrency exchanges like Kraken and Coinbase to report and provide their clients with 1099Bs. And we ended up with a very broad definition of broker in the statute. And then Treasury has taken that and a little bit of a step further, some might say, and taking that broad interpretation to heart, and possibly in a really expansive way. So,
for those of you who haven't read the rule, good for you. It's about 300 pages, and it's hard to get through, but luckily Lawrence and everyone on this panel has. Lawrence is like a live Cliff Notes, so he's going to help us go through what the rule means and what exactly the IRS is trying to achieve in this language.
I don't know how I got this burden to explain the meaning of life for tax in 5 minutes or less, so it's 300 pages. So Michael gave a brief overview, a very good overview of the origin and what these rules were supposed to do. Basically what these rules do is they are broker reporting regs. For those of you who don't know what that means, there's this whole world of information reporting that arises generally in January of every year. You get a 1099, you get a W-2. The notion from the government is, or has always been, that if this information is reported to the government, the taxpayer is going to then report it on his or her tax return. So it ensures compliance with the existing regime. As Michael said, there was this notion that there's underreporting in the world of crypto. There is no such regime right now for crypto transactions. So what these 300 pages attempt to do, it's the implementation phase, it's a set of proposed rules, is they define who is a broker, they define what transactions are reported, and then they define when they get reported and with effective dates. Now, I said that, again, that's in 30 seconds or less. Just imagine, though, that it's as expansive as you could possibly imagine. So, whereas the TradFi regime that Michael described is generally limited to financial and investment activity, so what you report is securities transactions, commodities transactions, that's what your custodian generally will report to you at the end of the year. For the world of crypto, it's everything. It's all digital asset transactions. Okay, so who is a broker? Basically, a broker, as you typically think about it, would be a pretty narrow category of people, and that's what we spent in 2021, what we worried the most about. Pretty much anyone who facilitates a transaction with digital assets becomes a broker. So that's a very expansive universe. What is reported? Basically, every digital asset transaction, including those that are not financial or investment focused. So purchase of a cup of coffee gets reported. Stablecoin transactions get reported even if there's no gain or loss. Just everything gets reported effectively with this regime. And then when is it reported? It's generally reported in January, and with effective dates beginning in 2025. So we're supposed to build, imagine if you're in the crypto universe and you become defined this way and you become a broker, we're going to have to build this all by the beginning of 2025. That gives us less than a year to actually implement this. That, in a nutshell, is the meaning of life.
I love the explanation. So I don't know how many in this room have ever filed their taxes by themselves, but it's really hard. I did it by myself last year, and I don't plan on repeating that again this year. But Vera, if this rule were implemented, what kinds of new complexities and burdens would taxpayers face?
Sarah, first, thanks for having me here. I have to say, when I lose my voice after a late night, I also tell everyone I've been spending a long time talking about policy. You're absolutely right. First, I'll actually start by saying what's not changing with these regulations. And what's not changing is that as a taxpayer, you're going to have to file your taxes. So if you're expecting to get away with it, nothing has changed here. You're going to have to file your taxes. It's still burdensome. It's very hard, and it's especially hard in crypto. What is changing here with these regulations is that the IRS is now going to know if you've bought and sold crypto. And so through this legislation, kind of the core point of why the IRS is doing this is they're trying to drive up, according to our estimates, 10% compliance rate in crypto taxes to close to 100%, right? That's why they're doing this. And frankly, in doing this, they're putting the burden on you as the taxpayer to get to your accurate crypto tax liability. So let me explain why that's the case. Let's say you buy $1,000 of Ethereum on a centralized exchange like Coinbase or Kraken. You transfer it to your wallet. From your wallet, you then transfer it to decentralized exchange. Maybe you transfer it back to your centralized exchange. You lose your cost basis as you transfer these things. And none of these entities are going to have that cost basis. And let me put this in perspective in the numbers. The IRS is expecting 8 billion of these forms, 8 billion. And on average, that calculates to 50 forms per US taxpayer. So imagine it's January, you're dreading doing your taxes, it's going to be so hard, crypto is really confusing, and suddenly you get 50 forms that are incomplete, basically. Most of them are going to be incomplete.
And some are duplicative.
Some are duplicative. It is going to be a mess. And so the good news is actually this problem has existed for some time, and the regulations really amplify it. It's why the crypto tax software industry, like CoinTracker, has existed for some time. We've helped taxpayers file over 1 million of those forms in the past. But really the core of what the IRS has done with this is say, hey, taxpayer, we rely on you to figure out this really complicated thing. And so you're going to need a tool. You're going to need to come and calculate your taxes accurately in order to get through the tax season.
And Michael, as someone who will be creating these forms, how would you say that the rule will impact your business, and how does it apply differently to you as a centralized exchange compared to other parts in the decentralized parts of our ecosystem?
So as we talked about here, this very expansive rule, it defines broker very broadly. So the original intent was, of course, to capture centralized exchanges, the Coinbases and Krakens of the world. And we are in a pretty good position, relatively speaking, to actually enact this rule in the sense that we are better positioned. We KYC clients, we are the custodians of the assets, and a lot of transactions completely happen on our exchange as we are both the exchanger and the custodian. The difference is once you move into the decentralized space, right, the systems just don't even exist. And so this broker rule basically comes in and says, we want beyond the centralized exchanges, we want any piece of software that has the ability or reason to know the person who transacted. And we're going to treat them as a broker. And now they have to report. And so that broad definition just can rope in multiple links. You know, you were talking, Vera, about the multiple links in a potential transaction. Each and every step along the way, you have another broker. And they each can also play a role in the same transaction. So when we're talking about these 1099 DAs, you end up with the potential for multiple 1099 DAs for the same transaction to one taxpayer. And for a taxpayer to make sense of that would be incredibly burdensome, confusing. It makes for a very messy, messy situation. So it's really, it's something where centralized exchanges, yes, we're positioned to at least do something realistically probably should have been something closer to the 1099Bs. Just go with what TradFi does, and that would have been something that could be implemented a little bit easier. But we ended up bringing along, and suddenly this proposed rule ropes in decentralized software providers and other people that currently don't even have any ability or any software built to KYC clients and actually comply with these rules. It requires, information, not just the KYC information. It has to have the transaction IDs. You have to have information on what was actually transacted, the wallet information, all of this stuff going in and being reported into the IRS under these rules.
It's interesting. I think about, it was just 2 weeks ago now, it feels like forever ago, that we all submitted comments for the proposed rule. I think there were about 140,000 in total submitted, so there's a huge number of individuals who are passionate about this and who are speaking up. I'm curious what you all are doing on the advocacy side, and what messages are you trying to convey to the government?
Yeah, absolutely. So as you mentioned, the IRS received over 100,000, 140,000 comments. 12 companies testified. It's going to take them some time to get through all of those comments. And we have some signal that they're listening. So there is some hope that they can make adjustments based on our industry's recommendation. I think at the same time, while we wait, we don't know where they're actually going to get finalized. We know there's pressure from Congress, so it could happen sometime early next year. I think our perspective at CoinTracker is we can make progress on some of the core issues even starting today. So for example, the burden that I mentioned about the taxpayer, I think we can help make those incomplete forms much easier for them to solve. So on the taxpayer side, they can use a tool like CoinTracker. We're eager to partner with the industry to help fill in the missing cost basis coming from the user as a source of truth. So we're hoping to take action and make some change that helps the taxpayer in the meantime.
I want to unpack a little bit of what my colleagues have said here, and I think the net effect or the conclusion you would draw is that the rules as proposed are essentially unadministrable. So I think when you talk about 8 billion forms, that itself sort of conveys that that's just not practical for one industry to report 8 billion forms. We actually estimated with the 8 billion came from the Internal Revenue Service, it didn't come from the industry. If you multiply 8 billion by the cost per form of what it would cost to actually undertake that process, and you use the IRS's own numbers in the regulations themselves, that's $500 billion. That's just inconceivable. It's just inconceivable that the government would require, unless it wants to shut the industry down, $500 billion worth of compliance. So 8 billion to me is almost a non-starter. And I almost think that they floated that number because they recognized themselves that they couldn't possibly ingest. Because again, let's assume that Michael and I fully comply, which we will, and we're the best equipped to actually do that, and we file all this information. The government has to actually build the construct, the systems to ingest all this information. And as we know, I actually was on the Hill earlier, and when I talked about this, they said they compare and this is from the government, they compare the system to the Flintstones. It's a little bit like the Flintstones absorbing this. So I just think that it's effectively, in its current iteration, unadministrable on its face. And so we have to come up with a better solution, a better mousetrap. I think Michael also said something that I think should be known here. So we represent the centralized intermediation process. We're the most equivalent to traditional brokers. I was there in 21. I think it was really intended and best intended for us, and that's where we should start and leave the rest for later. But I think I think the central tension for anyone here in this room is that a centralized system and crypto don't necessarily sync, because you're effectively taking a centralized system and imposing on what's in its purest form as a decentralized ecosystem. And that just creates inherent tension. And that tension will persist unless we sort of recognize how to address that problem. Our solution, which we advocated, we were talking about this earlier, is a blockchain. The best answer, if you were just inventing this from scratch or doing this out of the box, would be not to impose a centralized system on crypto, but actually to use the blockchain for tax reporting, to preserve anonymity with tokens, do attestation, and have some type of smart contract that reports information. I think we could actually do that. So I think that would be the more exciting part. It's what makes my job exciting. But in its current form, it's as bad as we've all described. I don't want to underestimate that. It really is. These regs are bad.
What do you think, Michael?
Oh, they suck. But I think, to your point, I think there has to be some recognition here that this is just completely unworkable. And I do think that Treasury and the IRS are going to listen. You know, when you point out that $500 billion number, kind of makes you reflect back on that $30 billion revenue score and realize, whoops, you know, kind of a bad scoring system.
Right. $500 billion to raise 28 billion.
28 billion.
Like,
yeah.
Yeah. Cost-benefit analysis.
Not a good cost-benefit analysis there. But to your point, I do think that there has to be a solution that is better. And so you could envision a world in which there is a phased implementation, to your point here, that we as an industry can accept that, yes, centralized exchanges are very analogous to TradFi brokers. They have the KYC information, they have the information to be able to comply, and realistically provide clients, customers, the information that they need to see gains, losses, all the traditional information that you use, and just simplify the tax reporting process and make it easier for the taxpayer. And then it becomes incumbent upon the industry, where the Treasury has kind of laid out their first volley here. This is kind of their marker. Hey, we want all of this information. We want to ensure compliance in the DeFi space. So how is that going to be accomplished? Because there is an element of a legitimate policy concern that they have. And it could be seen in the tensions even in Congress, back when this thing was first passed, is that there is an interest in somehow capturing and creating some type of mechanism for reporting for the entire DeFi and crypto ecosystem, even outside of centralized exchanges. It's just that right now, you have the vast majority of transactions on centralized exchanges. And so realistically, that's kind of what you can tackle first. Then give some time for the industry to develop the better solutions. You know, if you're going to decentralize finance, kind of decentralize tax reporting too.
I'm curious what you all think. So for those of you who haven't read the rule, they basically say we're doing this in part 1 and part 2, to your point about piecemeal. But instead of doing CFI and DeFi separately, they're saying we're doing just the broker reporting, and then we'll do broker-to-broker transfers. I'm curious what you guys think will come out of the broker-to-broker transfer part, especially knowing, I know it's hard, a little crystal ball moment, because we don't know how the final regs are going to look, but what do you think we can expect?
Maybe I'll take a stab at this. I think that that's what's really problematic here is I think that there is an anticipation that some sort of a transfer rule will help solve this missing cost basis problem that I explained as the user is transferring between exchanges across DeFi, et cetera. And unfortunately, it's really not going to work. Because the true, like I mentioned, the knowledge of what a user is doing across a decentralized financial system is going to live with the taxpayer. It's going to live with the user. And so if you have a transfer system, yeah, maybe through a couple of centralized exchanges, you could get a few transfers. But again, these 1099s are going to have really significant gaps. And therefore, similarly to what my friends here are saying, this kind of phased approach of like phase 1, actually let's trust the taxpayer to fill in these missing gaps in the 1099 forms, help with the processing of these 8 billion forms, like use that taxpayer's information, I think is a really important kind of step towards what I think we all agree is really important, that we start over and kind of rethink how we can do this in a decentralized world. You can enable a tax model that does this at the wallet level, and so you can really understand either with privacy or some sort of a KYC model how to get to the right tax outcome. So it's really early that we're trying to develop some of these solutions, but I think it has to be a phased approach where we help the IRS's core goal of driving up compliance do so by decreasing the burden on brokers and taxpayers, and then start thinking through how to do this in a decentralized way.
How open do you guys think the IRS is to this kind of feedback?
Well, we're going to find out. So the whole notion, and this is quite controversial actually, is because there's this whole notion of discretion to regulatory agencies under a doctrine called Chevron. The whole notion of this is called notice and comment. So the IRS, through the Treasury, proposes regulations. We're in what was called the notice and comment period. So there's a 60-day, they only gave us 60 days to actually, and they extended that by another 15, but they gave us basically 75 days for comments. And now they sort of regroup and they decide what comments are relevant and what they want to do in response to that. and they finalize regulations. Sometimes they can re-propose regulations. Sometimes regulations sit by the wayside because they effectively just don't know what to do, and it's just impossible to develop a craft a solution that they can implement. But essentially, we're now in the post-proposed stage, and they will now take that under consideration. One would think that the 150,000 comments, which reflect a lot of people saying boo, but a lot of substantive comments, will be taken very seriously. They actually are required by law to do that. So if they finalize regulations and just say, we ignore everything that people said and this is what we're going to do, that actually wouldn't stand muster in court. So they'll be litigated against if they do that. So they have to take into account all the consideration, all the comments that were actually made, and then finalize regulations. I think in general they have been open to dialogue. I mean, it's not like we don't talk at Coinbase to the government. We talk to all governments around the world, and I try to make the argument of why more is not necessarily better than less, like try to tailor where the risk is and adjust it. I think they'll be responsive. They are required to be responsive. How much we genuinely don't know. I don't think so the other rules that we were talking about that have not been subject to regulation yet, this broker rule, it's the tax equivalent of the travel rule. I just think they couldn't possibly tackle that before they built the building block of what's actually reporting, before they then have and this basically means like if you transfer something from Kraken to Coinbase, all that information that you had on Kraken gets transferred to Coinbase. Similar to if you bought stock in E-Trade and you transferred it to Fidelity, that would get transferred so that you can effectively do your reporting accordingly. That's extremely difficult to implement. I don't think we're going to see that, honestly, for some time.
Michael, do you have any examples of the IRS track record for building new systems, or how do they usually do when they take on these types of efforts?
I think you're seeing it actually play out right now in real time, ironically, with the implementation of what we refer to as 1099K reporting, which is basically for certain purchase transactions. And the limits got lowered for 1099Ks recently to $600 transaction limits. So you'll suddenly see a lot of payment processors now having to go through the process of getting W-9 information digitally, generally. And we've seen this rule and the implementation of it get kicked and postponed and postponed, and just a couple days ago, postponed once again. And part of that is really because the IRS doesn't know how to cope with this, and they need to build up systems to be able to ingest this information. So if you're envisioning something much larger, right, like this is, as proposed, they wouldn't be able to do it.
I don't want to harp on the 8 billion again, but I will. So 8 billion transaction reports gets reported to the government. The entire information reporting regime we have today only includes $5.5 billion, 5.5 billion transactions. So all the 1099Ks that Michael just referred to, all the 1099s you get from existing brokers for financial services, all the W-2s that are submitted to the government, that's 5 billion, and yet the crypto ecosystem alone is going to be required to report 8 billion transaction reports to the government. Just imagine and they cannot implement this regime for payment processors. That's the rule that if you like, it's the Venmo rule that you might be following. So if you sell on Venmo or you offer services on Venmo is required to report that to the government so that you'll report your income on your tax return. They can't implement that, or there's also the politics of implementing it with that level of threshold. So again, I just think it raises the point about administrability and what you can actually do. And I just think that's a big, big challenge. It's something they are theoretically using the $60 to $80 billion worth of funding that they got to do.
I know we're almost out of time, and I didn't know if we would have time for this question. So I'm curious, what parts of the tax code do you think our audience it's not on their radar, but they should be thinking about, especially as we go into 2024?
Actually, you stole my thunder. I was going to say the 60-45 Cap A, the transfer section here. I think that they're going to really struggle with that because crypto is fundamentally different. We're all transacting across a broad set of services. That's kind of the promise and the beauty of our industry. And I think we have to approach taxes differently as a result. So for that clause, I want us to rethink it. And I think as an industry, we can come up with a better solution, again, relying on accurate taxes that live with the taxpayer.
So I'm going to go totally off the broker reporting regime. The best provision, the most exciting part of the Internal Revenue Code that affects crypto is Section 61. Section 61 is the question about what is income. So to me, why is that important? Because everything in crypto is going to be based on when do you have what is income, are rewards, staking rewards income, and when should it be reported? That's all essentially out of what Section 61 is called income recognition and realization. All that is encompassed within this wonderful code section called Section 61.
I'm actually on board with you on that one because it really is, and I hate to just echo the same thing, but it truly is a big fundamental question that's hanging out there. So I do think that there's just big
It's the meaning of life for tax.
It's the meaning of life for tax.
What is income when you get taxed on it?
It's the first section of the code you learn in law school, right?
If anyone's interested in these questions, you should join our tax working group. Just a shameless plug at BA. But thank you all so much for the wonderful panel. If we could give a round of applause for them. Thank you.